Welcome everybody to the August 2024 Markets Monthly session. I'm Doug Huber, the Deputy Chief Investment Officer of Wealth Enhancement Group. I'm joined by Gary Quinzel, our Vice President of Portfolio Consulting. We're going to walk through just a couple updates on the markets and what we're seeing from the investment team. July was an interesting month. It's the first month in some time we actually saw a notable rotation of leadership in the equity markets. For so long, it's kind of been a one-trick pony of a show where we've heard so much about the Magnificent Seven and AI and all technology leading the equity markets. July was interesting in that we saw small cap and value stocks rally on softer inflation data and expectations for rate cuts from the Federal Reserve. Despite a modest uptick in unemployment, most of the data we are seeing suggests that consumer spending remains strong and that economic growth might actually come in better than expected going forward. And so we have some slides on that I know Gary will walk through as well. Where we think we are is, we've been in an environment where for the last little period here, bad news was actually good news in the economy. The markets were reacting because they thought bad news was signaling the Fed would cut rates. And I think that got priced into a point where now actually bad news is bad news, and we saw a little bit of that in August, and we'll touch on that. But from here, I think we should expect bouts of volatility because we're coming off such a low volatility environment, and the market could overreact to news and of economic uncertainty here. And so I think with that said, where we stand is that having a well-constructed and well-diversified portfolio that is aware of the risks it's taking, and with that allowing for opportunistic periods of rebalancing when volatility hits is, we think, the right way to be positioned in this market. So Gary, I'll throw it over to you if you want to walk through the first section here.
Thanks, Doug. So we're going to talk a little bit about market performance, and I know that this is July performance, and we're a little bit later in August right now, so some of this is a little bit dated, but I think, Doug, you hit on some really important talking points, and it really has been quite some time since we've seen that rotation of leadership, and we've seen what small caps can do, right, when priced correctly. And so the story behind the small cap rotation was finally about the market coming to grips with this expectation for lower interest rates, right? And the fact that inflation is finally coming down, right? We've been talking about this for a while, but I don't think we've really appreciated the magnitude of what that means for small businesses that just simply haven't had the pricing power that large caps have had over the last couple of years. So we started to see that really notable rotation occur in July. And then, of course, end of July into the first week of August, we saw a notable uptick in volatility, which I'll talk more about in just a second. But let's take a look at some of the other sectors that performed well in July as well. We saw a strong month for bonds in general, which are once again back in the positive territory for the year. Certainly, it's been a rocky road for bonds overall, but we saw strong performance out of high yield corporate as well, which we've talked about a lot, how tight those spreads are and how potentially overvalued they are, but still turning out strong performance year to date. I'm going to go ahead and jump a slide here and just kind of dig in, double click on that rotation, because I found this to be really interesting. If we took a look at the year-to-date performance of 4 sizes and styles through June 30th, we could see large cap growth massively outperform, driven by Nvidia and Meta and other large cap stocks, especially any stock that was able to capture the tailwind of AI, which has just been such a powerful contributor to the story that the market has been appreciating. And so up until then, we saw small value actually in the red, negative 0.85%. We saw a 180-degree turnaround in July, and that really all ties right back into that story about this forward-looking assessment of lower interest rates. We're finally on the cusp of actually realizing that, and we are seeing consistent progress on the inflation front. Prices are still high, but we are seeing that steady path lower towards a more normalized inflationary period, which can be good for small cap stocks. But of course, everything got kind of turned upside down as we turned the page into August, and we saw a historic surge in volatility, right? If we look at this green line, this is the CBOE VIX index, which essentially uses the options pricing to turn out and express how volatile the underlying equity market really is. And we can see it was the most volatile since the pandemic. And there was a lot of things that happened, right? That caused this kind of unwind. There was a move by the Central Bank of Japan to raise interest rates. It helped spur some unwinding of what we call a carry trade. Those investors that are long the yen because it was cheap and invested in other higher yielding assets. So there were some technical factors which unwound in a very rapid fashion. But fortunately, a lot of that has come back to earth. And some of the things that Doug talks about, this thought around the bad news being actually bad news, well, we have to take a little deeper lens from the underlying fundamentals of the economy before we really jump to any conclusions. I agree with the statement that for a long time, bad news was looked at as good news by the market because markets were pricing in rate cuts. But the real big question is, it comes back to this assessment of whether or not a soft landing, that is, are we going to have a recession or not, is really into play. And so with that, I'm going to pass it back to Doug. He's going to talk a little bit about some economic observations.
Yeah, thanks, Gary. And I think you're right. I mean, I think we're always trying to figure out what is, bad news, right? And is it a market overreaction to something, or is it really a trend that we need to be aware of and thinking about that could, potentially have larger and longer term effects on the economy? I think while we're talking about July, obviously the bout of volatility that recently started in kind of the early half of August, it really started on the back of a somewhat unexpected weak unemployment number. And there's been a lot of talk around this idea of the SOM rule. And essentially what the SOM rule is a leading economic indicator that since the 1970s has, I think, successfully predicted 9 recessions. And it's essentially looking at the uptick in the 3-month moving average of the unemployment data relative to the prior 12 months. And if it goes above half a percentage point, that has been historically the trigger point to indicate a recession. And so there was a bit of a surprise with the weak unemployment number, and it so happened that weak unemployment number put the SOM rule at 0.53%, which is above that 0.5. And I think the economy, the markets looked at that and said, whoa, this isn't quite what we were expecting. And there was a reaction there that maybe, the Fed had gone too far. They had not cut rates early enough. And we were about to, we were kind of standing on the edge of the cliff looking over. And so that has really been, something that was impactful to the markets. I think going forward, though, what we think is, we want to just keep an eye on this data. There's a world in which it could blip over and then come right back down. And so we're trying to pay attention to some of the other economic data that is out there today. I mean, if you look at, we can jump forward one here. If you look at the ISM surveys, which these really tell the story of manufacturing and services. And I think there we're kind of getting a bifurcated read on the economy. The manufacturing side is signaling a little bit of softening. That has come out in the latest data. But interestingly enough, the services side is looking very good. And the services would include things like retail and agriculture. And so, you're looking at this data and you're really trying to piece together what is the economy telling us. I think if we move forward one more slide here, what the real-time data is suggesting, and this is where we're spending a lot of time, is that the economy is still expanding. We are looking at daily and weekly data as well as these monthly reports, and we're seeing really strong data points across the economy. Restaurant bookings are up. Air travel is well above where it was pre-pandemic. Credit card data is showing very, good spending levels. There's the flip side of that coin that we have to monitor. Credit card charge-offs are people just spending money that they can't afford. But in general, it looks like spending is up. Oftentimes people will look at theater and Broadway ticket sales to see how the consumer is doing and see activity. They have been very strong. Hotel occupancy. So a lot of the things that we would look at as other data points are really signaling more of a green light in relation to the economy. And you can see in this chart here that relative to where consensus estimates have been on how the economy is expanding, kind of the future estimates now coming out of the Fed here is saying, hey, we actually might be doing a little better than we think. And so it's an economy that is interesting. We're very long in the tooth in this cycle. And so what we're trying to figure out is where exactly are we? Can we navigate that soft landing that Gary described? And I think for the most part, a lot of the indicators are suggesting we're doing pretty well. but there are some that were, teetering on the edge of saying, hey, could we potentially slip into a little bit of a softer position than people thought? And so that's really where we're monitoring for the economic cycle today.
Thanks, Doug. And as we always do, we always like to kind of take a few steps back and like take a broader perspective about what we just experienced. And again, what a difference a few weeks makes, right? Because, that first week of August, things looked a little dicey, right? And a big reason for that is just simple investor behavior, right? We all get complacent. And one of the reasons that we do is because we went an extraordinarily long time without a notable drawdown. And so this chart I find is really interesting. It shows historically all the way back to 1999, the number of trading days that we've gone without a 2% drawdown. And that's, there's no scientific thing around 2%, but that just means it's a notable bad day in the markets, and it kind of gets people's alarms go off when they see that. And so we just went around 355 days. The last time we went that long was around 2017, and then going all the way back to 2003, all the way through almost 2007, we went over 900 days, which was just an extraordinary amount of time of just low volatility. So what happens, if you picture that chart that I had with that VIX, right? We go through these periods, right? We just assume that every day is going to go up by a little bit. And so when we do have a little spurt of bad news, right, it often causes these overreactions. And I think that's most likely what happened, right? As we assessed the potential for the SOM rule creating a recession and the technical factors that were influenced by what was happening with the yen unwind trade, they all culminated in enhanced volatility. Fortunately, a lot of positive news has come back into light, especially the retail sales data last week and some other supporting economic data that says, you know what? Yes, we're moderating. Inflation is coming down. We're not all the way there yet, but it's just moderating, not falling off a cliff. And so I think we can live with that. It kind of puts us in a better situation. And so we always are just interpreting and moving real time with the data and looking for where are the opportunities now. And so I thought this was pretty interesting. This is the forward-looking U.S. Treasury yield curve. I know a lot of lines here. It might not make a lot of sense, but the way to think about this, if you look at that top line, that dark blue line, that shows you the forward-looking yield that you can get on a U.S. Treasury 1 year ago. And 1 year ago, we were still expecting higher interest rates or steadily higher interest rates all the way out for up to around 1 year, right? We were not expecting rate cuts at that point. Today is that light blue line, and we can see that forward-looking expectations have come way down, right? That easy 5.5% that you're getting on your short-term cash equivalents, that opportunity will not be there in the very near future because rates are expected to be cut. It also shifts where the attractive points are to invest on a longer-term horizon. And one thing I'll point out, if you look further out from 5 years to 7 years, what we're seeing now is that slope is starting to get a little more steeper. It's going to go from lower left to upper right as you go further out in the curve. And that's really where you want to be as investors, right? You want to own yield along the steeper part of the yield curve. That's more normal. That's where you can expect price appreciation over the long run. And that's where you can lock in longer term attractive yields or yields that are more attractive than we've seen over a better part of the last decade or so. So this moves constantly every single day. We use this as a tool that helps identify where the attractive points are to invest now, where we think yields are going to be in the short term, and where we want to invest on a long-term basis. And before I hand it back to Doug, I'll just show this probability chart, which again, this changes by the minute, but this tells you in real time what the Fed futures, the people that are betting on Fed futures, are predicting where the rates will be at the next meeting, which is on September 18th, and then following that, November 7th, and so on. And what the market is telling us right now, they think that there's a 78% probability of a 0.25% rate cut and a roughly 60% probability of rates being 0.5% at the meeting following that. Once it gets further out than that, things change so much on a day-to-day basis, you really can't take away a lot of very definite takeaways, but it is really interesting. We do factor this in as we assess our opportunities for investing client assets. And with that, I'll pass it back to Doug to take us home.
Yeah, thanks, Gary. So I think just to wrap up here, let's, just touch on some of the high points here. I think despite, a couple of data points that took the market by surprise, I think most data we're seeing today suggests that the economy is still on solid footing. But that is something we're monitoring closely. To what Gary just pointed out, a September rate cut certainly appears likely. The question is by how much. And this week, there's meetings going on in Jackson Hole, and I think this may send a signal, to the markets of what might come out of that. We do anticipate, because of kind of the fragility of these data points, that equity volatility will remain somewhat higher than it has over the last few months. And we also have, we're dealing with a lot of geopolitical tensions as well. So there's a lot of things that are moving around that could have these kind of overreactions, short-term kind of sell-offs around just being scared about something that comes through. But I think we're paying more attention to that medium and longer-term trends. So where does that put us in terms of opportunities? I think the rotation in July was interesting, and this could foreshadow a script that investing, for a lower rate environment, might open up opportunities beyond large cap growth. That said, a lot of these companies got very big for a reason. They're great companies with really strong earnings growth, and so when they get when they get repriced, which they have, there could also be opportunities to rebalance there as well. We certainly think that yields for the ultra short bonds will decline as the Fed cuts rates, and so we are looking at to look further out and maybe lock in yields at steeper parts of the curve today. And then I think finally is just maybe use that volatility to our advantage. If we see opportunity to harvest some losses, to put cash that has been on the sidelines to work at more attractive valuations, or just rebalancing towards long-term goals, while volatility in the short term can be a little uncomfortable, it often is actually what leads us to be able to make better moves inside a portfolio. So with that, Gary, I think we can wrap up. Anything else you want to add?
I think that's all. Thank you so much. Have a great day.
Thanks, everyone.